been a really interesting day of economic data for the Eurozone and the US. So let's take a deep dive into the economic figures, what they mean for the central banks, and then ultimately what that means for the euro-dollar pair. First up, we had the Eurozone inflation data this morning, the HICP data, which is the Euro area's preferred measure of inflation. Now, we had a couple of releases over the last couple of days from individual nations, so that tends to give us a bit of insight into what we can actually expect from these figures when they're released today. And as expected, we saw the headline number come in a little higher than was previously forecast. That's a trend that we have seen across a couple of other nations over the course of the last couple of days. And the core reading did show a modest decline as well. Now, you could argue that this has something for the hawks and the doves on the ECB, but ultimately what this means is inflation is heading in the right direction. Headline inflation remains a little bit volatile because energy, again, played a big role in this. Unfavorable base effects on this occasion, meaning we saw higher levels of headline inflation. But the fact that core inflation is continuing to fall is broadly a positive. Now, there are arguments that this is more positive for the hawks on the ECB. In other words, those who think we should raise interest rates again in September, but markets seem to have taken that very differently. If we take a look at the probability distribution, this is from Refinitiv Icon, you can see that based on futures pricing, that markets have shifted slightly from it being a coin toss at the next meeting in a couple of weeks' time to there being a roughly 70% chance of a pause at this meeting, which will occur alongside new economic projections, and then maybe a rate hike further down the road, meaning just a 30% chance of an interest rate hike in September, down from 50% over the course of the last week or so. So clearly markets are taking this in more of a dovish position, perhaps highlighting maybe the core inflation decline rather than the headline inflation beat, seeing that core inflation number as more indicative of the positive trend that we have seen on the inflation front across the euro area over recent times. You could argue that the unemployment number is less favorable, but I think inflation at this point is still king as far as the euro area is concerned. Then we'll take a look at the US data. The US data was really important also. It was also a batch of inflation data, but it also accompanied income data, spending data, and jobless claims figures. Now, there's a few things we need to highlight here. One is that the PCE, or the core PCE price index, is the Fed's preferred measure of inflation. So it is the one we should pay most attention to. It's the one that's going to inform their monetary policy decisions. The flip side of that is it's released generally around 2 weeks after the CPI figures for the same month. So we tend to have a pretty good idea that despite the difference between the two, the direction of travel that it's going to head in. So unless you see a big surprise on this front, you tend to see a more muted response in the markets than you would often see for the CPI readings, for example, especially over the last few years when it has been so volatile. And I think these numbers were broadly in line, so we don't necessarily gain too much information from this. The core PC price index on a yearly basis was 4.2%, a slight tick higher from the 4.1% in the previous month, but in line with expectations. The monthly reading was also 0.2% again, as was the headline PCE number, 0.2%. So I think the monthly trends on this are very positive. They would suggest that going into the end of the year and into next year, we are on trend for much more sustainable levels of inflation on an annual basis, which will give the Federal Reserve some comfort. The headline annual figure was 3.3%. That was up from 3%, but again, in line with expectations. While it goes against the trend that we've seen of declining inflationary pressures, it was also anticipated because, again, things like base effects, energy prices, etc., do feed into these headline inflation numbers more so than what we see at the core level. The income number was interesting as well, because the income number showed 0.2% income growth. Now, this will give the Fed some comfort because they have been concerned of a wage price spiral, as of central banks around the world. And this income number falling shy of 0.3 at 0.2, seen as more sustainable, in the right direction, the trend being more favorable, is going to be seen as a Fed-friendly release. The spending number, on the other hand, does feed in to the narrative of a resilient household spending economy. And I think that's going to be a trend that we have seen. And as inflation falls and wages surpass inflation, as we've already seen elsewhere, that is something that we could potentially see more of. But I think the income number is going to be far more important here, where the Fed would like to see a cooling economy, more slack in the labor market, and inflation falling. But the most important thing, I think, is inflation first and foremost, the labor market feeding into that. And if spending remains strong while income is falling, I think that's something that they will tolerate, and that could still bring about the end of the tightening cycle. The jobless claims number there, 228, only just shy of previous expectations and broadly in line with the trend we've seen recently. So let's take a look at what that ultimately means for Fed probability. Now, with the Federal Reserve, we're still up in the air, I guess, in terms of whether we are done. And that's not necessarily talking from a market's perspective, but that is certainly the narrative that the Federal Reserve itself has wanted to portray. The markets for some time have been of the view that we are not done, that we are done with the tightening cycle. There is a chance that we could see another rate hike in the cycle. But I don't think today's data necessarily changes anything on that scale. What we have seen over the course of this week is the expectation for the first interest rate cut being pared back slightly, so being brought slightly forward by a month. That was on the back of the JOLTS data, which was really interesting because it showed much fewer jobs earlier this week being advertised, which highlights that businesses are being a little bit more conservative. It actually brought it back to a more than 2-year low. Now, it was still slightly above the trend previously that we saw going into the pandemic, but it was only above the trend by around 1 million, 1.5 million, and it was much lower than the 11+ million peak that we saw at the height of the last couple of years. So we're seeing a much more positive trend in terms of jobs activity. And if we can see that now reflected in tomorrow's jobs report, in terms of job growth, creating this additional narrative of modest slack appearing in the labor market. The Fed would like to see much more, but if we can see this contribute to that narrative of more slack in the labor market, then I think that will give the Fed more ease to pause again in September and then consider maybe tightening again at the next meeting if the data doesn't continue to move in a more favorable direction. So that's the data covered. What does that mean for the charts? Well, we've got the euro dollar chart here, and again, it is interesting on the chart in that we've seen the pair pull back from that 109.50, 110 area. Now, around that 109.50, 110 area, you've got a couple of things from a technical perspective. We have the 55.89 day simple moving average band. Now, during sideways trends, that can sometimes be less effective, but as you can see over the course of the last couple of months in particular, it was providing decent support in July and August. We broke below here, and in August it has provided some resistance as well. And that also falls around the 38.2% retracement. That's from the July highs to the August lows. So the fact that these two levels coincide, I think, is interesting. Also just shy of 110 as well, which again is a big psychological barrier. Now, I'm not going to put an enormous weight on this level, but if we do rotate lower off of this point, including everything I've just highlighted, that could be quite a bearish signal, just because the 38.2 is a very shallow retracement, and falling from that 55.89 as well could be quite interesting also. We did run into support recently around the 200-233 day simple moving average band at this point in time. It's relatively wide, but you can see that that area did provide some support. And if we move back into that area again, then that would start to potentially look a little vulnerable on the basis of what we have just seen as well. So I think this is going to be a really interesting one to watch, especially over the next few weeks when we've got some more important reports, employment reports, inflation reports from the US, and then of course the European Central Bank meeting in 2 weeks, the Federal Reserve meeting in 3 weeks, and I think all of these will really set the tone, not just for September, but going all the way into year end, because the ECB meeting and the Fed meeting both contain fresh economic projections on top of those interest rate decisions themselves. So I think we've got a really interesting few weeks to come for the euro dollar pair and for the US and Eurozone as a whole going into the end of the year and 2024.